Respected dignitaries on the dais and of the dais, and with the permission of Lord Jagannatha, we'll start our session. And before starting, I will take you one word where I am working currently. One mantra is there, छुएंगे हम आसमान. And today's what topic for this 60-second NCMAC is that corporate excellence and CMA vision. So what I can say, all CMA, those who are either practicing or serving in the nation, they have to only have one mantra, that छुए में आसमान. तभी जाके हम लोग के प्रोफेशन में थोड़ा कुछ ग्रोथ ला सकते हैं, या कंपटीशन ला सकते हैं, या परफेक्शन ला सकते हैं. So considering this one, today I am here to talk a very serious issue, and I need your attention. That today I will not tell what is Ind AS, what is IFRS, but I will take you through what a cost accountant should know when he is doing a cost audit or preparing financial statement in any organization, how he should take input from either BRSR or IFRS or Ind AS or ESG, so that value addition or potential can be brought in the reporting for the cost accountants in any organization, whether they are in practice or in service. So guys, you can see here that the G20 submission, that what mantra we have told, that Vasudevaka Kutumbakam. So just like the world is a mini world and everything is common, considering the same funda, now we have taken and adopted or converged the international practices in India, and when we adopted the IFRS in India, that conversion process is known as the converged IFRS into Ind AS, and I will take you through one or two slides how that conversion has done. If you see, the modern economies rely on cross-border transaction. It is not an open market. Now it is totally open market. Anybody can sell his product or services any part of the world, no restrictions. And each entity, for their requirement, they want a free cash flow from the global. And all investors, those who are potential or present, they want to have a investment opportunity throughout the globe. They don't want to restrict their investment opportunity any part of the world. They want to have everywhere. But thing is that if somebody will come to India, or one investor who will go to abroad, if he want to do investment, first of all, he'll test check the financial health of the organization where they want to do investment. So when those countries are being following only national accounting standards, then to read and understand and invest in those countries, or prospective investor, those who want to come to do business in India, it is very difficult for them, and it is always carry a cost, complexity and risk while taking a decision for their investment. Considering all those things, a vision came to India through our erstwhile finance minister Arun Jaitley, that why not to converge the Indian accounting standard with the international practices. Considering that one, we converged the IFRS, that is International Financial Reporting Standard in India, and we have converged in the name of Indian Accounting Standard, that we are in short, we are telling at Ind AS. So IFRS addresses this challenge by providing one common reporting language, which is high quality, internationally recognized, and its purpose is that to solve all the investors' decision when they are taking any investment purpose, or they want to compile any financial statement, any part or any corner of the world. So if you see what is the essence of IFRS, why we brought it? Because it's a standardized practice throughout globe. Whatever the best practices are available any corner of the world, that has brought in that practices. So when it has conglomerated, so it has refined into a best practices in the world. When one company or entity who will adopt or report their financials under IFRS, it will give more transparency, strengthen accountability, boost economic efficiency, and it will give opportunity for more capital investment and lowering the cost of capital, because more FIA will come to India, then competition of investment will more, your cost of capital will be also reduced. And apart from that, there will be a uniform accounting practices throughout the globe. So any party or any entity or any company go any part of the world, it will easy to understand those things, and there is no interpretation or no conversion is required. And that is called your brand value. When one company is following IFRS, then any investor, any part of the world is very much interested to come and invest if they can easily understand those financial statements. So ultimately, what is the crux of the story? It gives clarity, reliability, relevance, and comparatively while you are analyzing any financial statement. So now time is that when where transition has made, the transition is that from accounting standard to reporting standard. The Erstwhile reporting was International Accounting Standard that has changed to IFRS, that is International Financial Reporting Standard. So nowadays, we cannot restrict ourselves only up to accounting. Now time has come up that we have to come up and we have to change our accounting to reporting, because reporting gives a layman more understanding than figures. So this is the chart I have taken from the IFRS Foundation. Now this green portion is that the countries, around 169 jurisdictions are there. Those who are following IFRS global, either they have adopted like Japan or your Bangladesh, or they have converged like India into IFRS. So this is one more thing, that IFRS Foundation has two boards. One is your International Accounting Standard Board and International Sustainability Standard Board. So as sir told, International Accounting Standard Board, they are the body who are responsible to create IFRS standards. And sustainability is the body who is responsible for creating this sustainability standard. So as of now, IFRS has developed 39 standards in IFRS and 2 sustainability standards are there. So just for your information, I am taking you through. So what is the need of Indian convergence to IFRS? First thing is that when the global economy has booming up and e-commerce is growing, so there is a imperative need of single global accounting reporting in India. Because India is a growing country, we have many investors in India, and many Indian companies are also going to abroad for their investment. And second thing, that to fulfill your capital requirement, you need to get your equities listed in other countries. So that also our Indian companies are doing. Considering all those things, this IFRS requirement has come. Third thing is that nowadays business is getting complex day by day. So when accounting, which is an international practice, will come, then more clarity or understandability will come. So Indian entity thought if we will bring that one, so considering the complexity, more understandable account can be given to the reader of the financial statement. Fourth one is that underpin the confidence of the investor. Considering many scandals or scams in India, the regulators have a requirement how to bring something that which will win the investor's trust. And that was the International Financial Reporting Standard. Then one more crux of the International Financial Standard is that it is a principle-based account. It is not a rule-based. It is not a rigid. It is flexible. It is judgmental. You can take many scenarios where you can apply the IFRS as per your judgment or flexibility. So there is no rigid practices there. And yes, when we implemented IFRS in India, we have done some carve-ins and carve-outs. And as far as possible, we try to match the corresponding IS and IFRS with the relevant standards. But wherever required, which is very much required, departures have been made. So this is called your carve-in and carve-out. With this process, the International Financial Reporting Standard has converged in India, and that is called Ind AS. So this graph, I need your attention. If you see this graph, the generally accepted accounting principle, everybody knows, it's a very large connotation. So if you see national gap, our AS, erstwhile AS was your national gap, that has now reincarnated into Ind AS. And this Ind AS has two components. It has not entirely IFRS. Certain IS standards are still there. Those IS standards are from 1970 through 2001. They have come to the Ind AS. Similarly, latest, whatever IFRS standards are there also, they have converged in India. So now, what is the beauty of IFRS? What are the highlights? Your valuation, like sir told, now options of valuation into fair valuation is there. Now this era is not on historical cost basis. It is on fair value basis. So we cannot restrict ourselves that we will report only on cost, only on historical cost. No. Now we have to come up with the fair value concept, and we have to do fair valuation like our financial instrument, Ind AS 109, or PP, property plant equipment, Ind AS 16. These are giving option to the user that if you want, you can convert your financials into fair valuation so that it will give you the real business entity, be a real business sense that what is the real value of the business. So those options are there in valuation which are missing in our AS. Time value of money is the fundamental principle of IFRS. So wherever anything is there, means suppose you have given any investment or you have taken investment, you have to take the time value into consideration so that the real meaning of the financial statement will spell out. And substance over form, this is one of the major highlights, which is talking about the economic reality of the transaction, not just their legal form. Means, suppose I have taken one piece of land, 500 crore rupees, I have not got the lease deed for that land, I have constructed plant and machinery over that. Somebody may say, there is no title deed for the land, even though you have erected the plant and machinery and taken control, but it is not your land because title deed is not there. But IFRS is telling no. You have to think about economic substance is what. Now that land is under control. So bring it in your PP. So is your lease land. Bring it under ROU. Don't show as a advance for capital. because this is called your substance over form. So these realities or the substances or the meaningful business has come under IFRS, which was not there under AS. Disclosure. It is one more essential part of IFRS. Now, if you see the financial statements, more disclosures are there and less financials are there. Why? Because one reader of the financial statement cannot read and understand the financial figures. You have to give adequate disclosures so that they can go and understand the business nitty-gritty. Materiality is also one of the essential element who's talking about that omitting, misstating or obscuring is just like a material decision which the investors is supposed to be taken, and by doing that they are not able to take. So they are telling ki many assumptions or adjustment you can based on or you can take on materiality ground. That for each small decision you no need to change your accounts. Then your approach. As I already told, it is a principal approach. So flexibility and allow for judgment is there. So it is not like rigid. So only a 2-3 minutes I'll take. Beauty of the IFRS is that it talks about explicit and unreserved statement. When one entity is adopting or applying all indices, then only they can give a disclosure that they have followed all the standards, and it is a mandatory requirement that all entity, those who are following index, they have to give one explicit and unreserved statement that they have followed all the standards. There one more concept has come, third year balance sheet. We have learned till now 2-year P&L and 2-year balance sheet. But IFRS is tell if any mistake you are doing or any error is there or change in accounting policy is there is no concept of 2-year balance sheet. Draw a 3rd-year balance sheet, bring all such error adjustment in the opening balance in the preceding financial year. Then other comprehensive income is one of our beauty, which is talk about all unrealized gains and losses. Like earlier we are reading only P&L. So now they have brought one more concept, other comprehensive income. So it is one statement, both will be there. P&L plus OCI will be TCI. So this is also one of the beauty of IFRS. Then definition of fair value and NRV, where fair value is a market approach, NRV is entity approach. This deliberation also given under IFRS or index, which were not present in AS. Then selection of material accounting policy. Whenever you are doing any accounting policy, you have to give a material accounting policy disclosure. So while doing your cost audit, we can also think about adequate disclosure in similar line. Then accounting change in policies. Standard is telling when you are changing accounting policy, you have to do retrospective application, and in case of any error, you have to do retrospective restatement. So these two options are there in IFRS. Then prior period item, there is nothing called prior period item. If any prior period item is there, it will be tantamount as an error done by the entity, and you have to restate your financials. Then deferred tax. Now when you are creating deferred tax, it is a balance sheet approach, whereas earlier it was an income approach. Then recognition of OCI and other things are also there. These are the all things which was not there in the AS, and that brought out in the IFRS to bring more reality in the financial reporting. So now question, my last slide, with this I will complete. Now this message is to all practitioners that through this INDES or IFRS, how to create vision to value. When we are doing cost audit or we are preparing financial statement, what sort of things we'll do so that in our report we can bring value addition. So INDES 16 talk about requirement of reassessment of useful life and residual value of asset every year mandatorily. My question to all practitioners here, when one company is restating or changing useful life or residual value for the property, plant, equipment for a particular reporting period, that depreciation charge will either come up or come down. So in those situations, whether you are checking your cost audit report while you are preparing, whether you are evaluating all these points, if you are evaluating whether you are giving the disclosure, so that the reader of the cost audit statement also come to understand that this impact is there. Similarly, INDES 38 talks about if any development charge, which is supposed to be capitalized, but you have debited to P&L, that you cannot bring back to capital asset. So when you are doing cost audit, whether you are disallowing those expenditures as a non-cost item, that also during cost audit you have to think about it. That whether, so to know those things, you need to know the nitty-gritty of INDES accounting financials. Third thing I will tell, if any government grant is there and you have done fair valuation, then that notional portion of the part you have debiting your asset and you are creating a deferred tax liability. So while doing the cost audit, whether all those things you are considering as a part of cost, that also you have to evaluate. So many aspects are there, like INDES 1 talks about not only presentation and recognition or measurement, it talks about disclosure. So whether you have thought of that when you are doing cost audit, you have you are telling your client to bring more disclosure to the cost audit? If not, then it is my request that just like international practices, now we are giving more disclosure. In my view, or it is my suggestion that more disclosure should come to the cost audit report so that the reader of the cost audit report will come to know what is the reality beyond figures. Will not rely on figures, will rely on the disclosures. How many disclosures you can give so that reader can easily read and can conclude the cost audit report. So let us not make cost audit only inside the company. It may help the management in decision making. So these disclosures can assist the management to read, understand the business, and then enable them to take many decisions on this way. So these are the things that you should think about it, and as time permits is not there, so I will not take you through many things. Only one last thing I will tell, that your regulation SEBI LODR 2015 regulation 34 subsection 2F talks about BRSR reporter for 100,000 listed entities. So I will not take what is the nitty-gritty, what is the BRSR and other thing, because sir has already spoken. Only one thing I will tell and close this presentation is with the BRSR core framework. All cost auditors should go through this audit report and they should evaluate the 9 ingredients of BRSR core. What are those? Greenhouse gas footprint, water footprint, energy and wastages. These are the things. When a cost auditor will go through this, he can really get the insight of the company, how the company is managing its business. Because here, when you are taking your assurance, you cannot hide now. And this is the area where we can really add value in the cost audit to the entities. How much is the green gas footprint is there, how the water conservation methodologies are there, energy, how they are saving, what is the wastage minimization is there. I can tell you, these are the things where you can take input, like Indes I told, like here also BRSR or ESG is there. You can take input and definitely you can enhance your value addition in the cost audit report, and you can take input from this and you can give a management a suggestion or direction how to do your business. So with this, I will conclude my session and thank you very much for your patience learning. Thank you very much.